There is a macroeconomic framework gaining increasing attention that suggests we are in the early stages of a profound and potentially historic global transition. This transition is not defined by a single event or moment in time, but rather by a gradual shift in how power, capital, and trust are distributed across the world. More specifically, the argument is that we may be moving away from a highly globalized, dollar-dominated financial system, one that has defined the last several decades, toward a more fragmented, multipolar order. In this emerging system, economic and political influence is no longer concentrated in a single dominant center, but instead spread across multiple regions, each with its own priorities, alliances, and financial infrastructure. In such a transition, the role of the US dollar does not simply disappear. It does not collapse overnight, nor does it lose relevance instantly. Instead, its function begins to evolve. Its dominance may gradually diminish at the margins, even as it remains deeply embedded in the core of the system. So if you are trying to understand what is happening to the dollar today, one useful way to interpret it is not through the lens of crisis, but through the lens of transformation. What we may be witnessing is not the end of a system, but the slow reconfiguration of the global monetary order itself. To understand this properly, it is helpful to step back from dramatic language and clearly define what we mean by a monetary order. A monetary order is more than just a currency or a central bank. It is a complex web of institutions, rules, incentives, and shared beliefs that determine how money is created, distributed, stored, and trusted. It includes financial markets, regulatory frameworks, international agreements, and the behavior of both governments and private actors. At its core, it is a system built on confidence. Confidence that money will hold value, that contracts will be honored, and that the system itself will remain stable. Throughout history, monetary orders have not been static. They have evolved, often in response to crises, wars, technological changes, or shifts in global power. Each new system tends to emerge gradually, overlapping with the old one before eventually replacing it. If we look back to the period before the 1970s, the global monetary system was at least partially anchored to physical commodities, most notably gold. In the United States, paper currency once represented a direct claim on tangible assets. Gold certificates and silver certificates were not symbolic. They were redeemable. You could exchange them for actual metal. This imposed a natural constraint on the expansion of money. This era is often described as a hard money system, where the supply of currency was limited by physical resources. While not perfect, it created a different kind of discipline, one that restricted excessive monetary expansion. However, in 1971, a pivotal shift occurred when the United States suspended the convertibility of the dollar into gold. This marked the effective end of the Bretton Woods system and the beginning of the modern fiat era. Under a fiat system, money is no longer backed by a physical commodity. Instead, its value is derived from trust, legal frameworks, and the credibility of the issuing authority. This change introduced a new kind of flexibility into the system, one that allowed for greater economic expansion, but also required careful management. From that point forward, the US dollar retained, and even strengthened, its role as the world's primary reserve currency. But its dominance was no longer based on gold. Instead, it was supported by a combination of structural advantages: the size and productivity of the US economy, the depth and liquidity of its capital markets, the stability of its institutions, and its geopolitical influence. Another critical factor was the widespread use of the dollar in global trade, especially in energy markets. Oil, in particular, became priced and traded in dollars, reinforcing global demand. Over time, an informal but powerful system emerged. Countries exported goods and services in exchange for dollars, and then reinvested those dollars into U.S. financial assets, primarily treasury bonds. This created a self-reinforcing cycle. Global demand for dollars supported U.S. borrowing, while U.S. markets provided a reliable destination for global capital. This structure enabled the United States to sustain trade deficits for extended periods. It could import goods at scale, shift production to lower-cost regions, and maintain high levels of domestic consumption. In return, it supplied the world with financial assets and a stable reserve currency. For decades, this arrangement appeared remarkably stable, almost permanent. But no system built on global consensus is immune to change. Over time, incentives begin to shift. Economic power redistributes. New players emerge. And gradually, the assumptions that once held the system together begin to evolve. In recent years, there have been increasing signs that such a shift may be underway. Countries are beginning to reassess their dependence on a single reserve currency. Central banks are accumulating gold at an accelerated pace, not necessarily as a rejection of the dollar, but as a hedge against uncertainty and a form of diversification. Gold, unlike fiat currency, is not tied to any one nation's policy decisions. At the same time, alternative payment systems and financial infrastructures are being developed. Some of these operate outside traditional Western networks, reducing reliance on existing channels. It is important to emphasize that this is not an abrupt or chaotic process. The dollar remains deeply embedded in global finance, and its dominance is supported by decades of institutional momentum. However, what may be changing is the marginal demand, the incremental preference for holding additional dollars over other assets. This distinction is subtle but significant. A system does not need to collapse to begin changing direction. It only needs to lose momentum at the edges. Meanwhile, internal dynamics within the United States are adding complexity to the picture. High levels of government debt, persistent fiscal deficits, and long-term structural shifts in the economy raise questions about sustainability. For several decades, the U.S. economy has become increasingly financialized. Growth has been driven less by production and more by asset appreciation, credit expansion, and capital markets. While this has created substantial wealth, it has also introduced imbalances, such as rising inequality and a decline in certain areas of domestic manufacturing. This brings us to the nuanced concept of a strong versus weak dollar. At first glance, a strong dollar seems universally beneficial. It increases purchasing power, makes imports cheaper, and reinforces global confidence. It aligns well with a consumption-driven economy and supports financial markets. But there is a trade-off. A strong currency can make exports less competitive and encourage companies to move production abroad in search of lower costs. Over time, this can weaken the domestic industrial base. A weaker dollar, on the other hand, can help rebalance the system. It can make domestic production more competitive, support exports, and reduce the real burden of debt. However, it also introduces challenges, such as higher import costs and potential inflation. In this sense, currency strength is not inherently positive or negative. It depends on the broader economic context and the strategic goals of a country. Another important perspective is purchasing power over time. When measured against real assets like gold, currencies often tell a different story than when measured in nominal terms. Over long periods, many fiat currencies, including the dollar, have gradually lost purchasing power relative to scarce, tangible assets. This is not necessarily a flaw, but a feature of modern monetary systems. Because money is created through lending, expansion is built into the system. Growth requires liquidity, but that same process can lead to gradual dilution. As global demand patterns evolve and new economic blocks emerge, the structure of reserves and capital flows may continue to shift. The future system may not be dominated by a single currency, but instead characterized by coexistence, multiple currencies, multiple assets, and multiple financial networks interacting simultaneously. In such an environment, outcomes are unlikely to be uniform. Asset owners may benefit from rising nominal values, particularly in areas such as real estate, equities, and commodities. Meanwhile, those who rely primarily on wages may find it increasingly difficult to keep pace with rising costs. Governments may respond by implementing policies aimed at strengthening domestic production, securing supply chains, and investing in strategic industries such as energy and technology. At the same time, technological innovation is likely to play a major role. Periods of systemic change often coincide with the emergence of new infrastructure, digital currencies, identity systems, and financial technologies. These tools can increase efficiency, but they also reshape how individuals interact with financial systems and institutions. There is also a geopolitical dimension. As the system becomes more multipolar, competition between major powers may intensify, not only in economic terms, but also in technology, security, and influence. So what does all of this mean for the average person? The honest answer is that the future remains uncertain. There is no single predetermined path. We could see an inflationary environment where asset prices rise but purchasing power lags. Alternatively, we could experience periods of deflation where asset values decline and economic activity contracts. What appears more consistent is that transitions tend to amplify differences. Those with access to assets, capital, and adaptability may be better positioned to navigate change. Others may face increasing pressure. We may, in fact, be living through a transitional era, a period in which the assumptions that defined the previous system are gradually being questioned and reshaped. Such periods are rarely smooth or predictable. They involve volatility, experimentation, and competing narratives. Rather than a sudden collapse, what we are likely witnessing is a gradual evolution, a slow but meaningful shift in the architecture of the global financial system. And while the final outcome remains unclear, one thing is becoming increasingly evident. The direction of change is no longer subtle. It is unfolding in real time, and it is becoming harder to ignore.